Hello, this is Professor Barati again, ACC 306 Financial Reporting 2. Working on week 2, which is revenue recognition, a pretty lengthy chapter, a lot of work. What I'd like to review is concentrate on the percentage completion method, because that to me is probably the more complex issue that students are experiencing with this chapter. Most of the other problems, although there are a lot of them in this chapter, tend to be just getting your schedule right and putting things in an organized manner, and you can basically get to the answer. A lot of it is just taking percentages of certain things, not as many journal entries and so on. So we're going to focus on the completion method because that entails schedules, calculations, journal entries. So it's very comprehensive. So I want to call up the PowerPoint and go over the theory first. And then part 2 of this will be to go over the homework assignment that you're experiencing. I believe it's problem 8, the percentage of completion method. You're going to find the percentage of completion method of revenue recognition is used very much in the construction and contracting business because essentially that's what their business is. They're lengthy contracts spread out over years, and they're measured in percentage of completions, and they're billed over stages. So that's basically a primary industry that uses that. Other industries will be a company like Boeing that makes jetliners. Those jetliners could take several years to build. Major government projects, building a oil rig platform, anything that is constructed over a lengthy period of time is probably going to be using this percentage of completion. So it's a major part of our economy. And that's why you should know it, because as CPAs, you most likely will come up against it. So let's talk about the type of accounts that you're going to learn in this method, which are new. These are kind of different accounts, which you probably haven't come across before. They're not your typical debit credit accounts that we've seen on balance sheets. So we're going to start with the construction in progress account, CIP. And the CIP account is basically, think of it as an inventory account, similar to a job costing work in process account that you've learned about in manufacturing. And this account is an asset. And all it does is it basically collects all the cost affiliated with this project. So you're basically debiting this account every time you're incurring costs. So it's an accumulator. So just think of it as a simple T account, an asset, an inventory type of account that gets a lot of debits for the expense that are incurred on this project. When the contractor sends bills to the customer or invoices the customer, it's going to create accounts receivable on the debit side. But on the credit side, it's going to create this billings on construction in progress account, or BCIP. And this is a contra account. And so to refresh your memories on what a contra account does, a contra account is an account that's in the same category as an asset or liability or equity. But instead of, for example, assets normally have debit balances, a contra asset account will have a credit balance. So it goes against the theory and discipline that we've learned. So an asset gets a debit but a contra asset gets a credit. So you could basically almost realize at this point the debit and the credit minus the credit is going to get you a net asset, or what they call a net carrying value. And this is basically the purpose of a contra asset. If it was on the liability side of the balance sheet, a contra liability, liabilities, as we know, have credit balances, so a contra liability would have a debit balance. And that essentially would be netted to get a net carrying value as well. So when we report the construction in progress as an asset on our balance sheet, this billings on construction in progress is the contra asset that's going to be netted against the construction in progress to get a net carrying value on the books. It's no different than having fixed assets such as machinery equipment. You're going to record machinery and equipment on the balance sheet, less accumulated depreciation, which is a contra asset, to give you a net book value. So it's the same theory. We're using the same theory as you would do with fixed assets. So we have this net carrying value of the asset with the CIP. In effect, this transaction replaces the physical asset with a financial one, accounts receivable. When the contractor receives cash, we're obviously going to debit cash and credit accounts receivable for that amount. So that's a simple entry that no one should have difficulty with. Now we get into the real revenue recognition, which is how to recognize revenue with this percentage of completion method. And basically the revenue and the costs associated with that revenue, based on the gross profit, which is revenue minus costs in a given year, are based on this percentage of the project that's been completed. Once we recognize that revenue, our journal entry will be to credit revenue from long-term contracts and debit construction costs. So long-term contracts and a debit to the construction costs. The long-term contract is basically the revenue account. So it's a credit to revenue. We give it this name, long-term contract. The debit, the construction cost, is the expense. So in that sense, it's just different names for the same accounts. The difference between the revenue and the cost is going to be our gross profit. And that gross profit, if it is a gross profit, will be debited to the CIP account. If the gross profit is negative, if it's actually a loss, it's going to be a credit to the CIP account. So we're essentially putting the gross profit on the balance sheet until the project has ended. When the project is ended, we remove the CIP account from the books with the credit, and we remove the billings on construction in progress, which is the contra account, with the debit. Why? Because the CIP has a debit balance. All the costs are associated with that project are debited to that account. Okay, and all the billings that offset those costs are in the contra account. So essentially, the gross profit is embedded on our balance sheet with these debits and credits. At the end of each year, the firm reports accounts receivable and accounts recognized profits in excess of billings on the balance sheet. If the CIP account is larger than the billings account, the net amount is called costs and recognized profits in excess of billings and is reported as an asset on the balance sheet. If the billings account is larger than the CIP account, or if the CIP account is less than the billings account, then the firm reports the net of the two in billings in excess of costs and recognize profits as a liability. So in practice, with a problem, you'll see how this works much better. A common method used in practice, the cost-to-cost approach, estimates the cumulative percentage of completion by dividing the total costs incurred to date by total estimated costs as follows. So to get this percentage completion measure, we have to take the total costs incurred to date and divide that by the estimated total cost of the project. That's going to give us a percentage completion. So again, it's not costs in a period, it's total costs incurred to date. The estimated total cost of the project equals the total actual costs incurred to date plus the estimated cost to complete the project. So the denominator, the estimated cost of the project, is the estimated total cost of the project, which equals total actual costs incurred plus estimated costs to complete the project. Firms will recognize revenue, costs, and gross profit in each year by computing cumulative revenue by multiplying the total estimated contract revenue times the percent complete. So we're going to take the percentage of completion that we just calculated here, and we're going to apply that to our revenue on the contract. Revenue for the current period is cumulative revenue, less revenue recognized in all prior periods. So to recognize a revenue in that one period, you're going to basically take the cumulative revenue of the project, and you're going to subtract, okay, the revenue that's already been billed from prior years. Actual costs for the current period are given in the problem. They're not basically subject to the percent completion. Computing gross profit for the year is the revenue recognized in the current period 1 less the cost recognized in period 2. So in this problem, NNI accepts a fixed fee contract to develop and implement a communications network. The fee is for $18,600, so that's our contract price. I must complete the project within 3 years, 2015, 16, and 17. NNI uses percentage of completion method of accounting, determining the percentage completion using the cost-to-cost approach. So, in this problem, we have actual costs incurred during the year of $3,000, $1,500, and $10,000, respectively. Estimated cost to complete. Estimated cost to complete. Total cost is $15,000. Estimated cost to complete is $12,000, $5,500, and 0. Estimated total costs are added up: $3,000 plus $12,000, $1,500, $3,000, $5,500, and so on. So, to calculate the percentage of completion, we're going to take total costs completed cumulatively and divide that over the estimated total cost. Under the percentage completion method, costs for the period are the actual construction costs incurred. In 2015, actual construction costs are $3,000, which is right here. The cumulative percent complete is 20%. We get that by dividing actual costs incurred during the year over the $15,000 to get 20%, which is estimated total cost. Because 20% is completed, 20% of the estimated revenue is also recognized. So we take the 18,600 and we multiply that by 20% to get to 3,720 as our revenue for 2015. Actual costs are straight in the problem at 3,000. The gross profit is 720, which is 3,720 minus the 3,000. The actual construction cost of 1,500 added to 3,000 in the next year, which is right here. Actual cost were 1,500, but we had 3,000 from the prior year. So we're accumulating this all along. So last year was 3,000, now we incurred 1,500. So we now have $4,500 of actual costs cumulative for this project. So 45 of cumulative construction costs through 2016. Because the estimated cost to complete are another 5,500, which is given to you right here in the problem, our total estimated cost is 10,000 in 2016. So 4,500 actual costs plus the 5,500 gives us the total cost, estimated cost to complete. The cumulative percent completion in 2016 is 45% and is computed as 4,500 divided by the 10,000. The cumulative revenue is 18,600 times 45%. But that's not the revenue we're going to recognize in 2016. It's the cumulative revenue, meaning for 15 and 16, our total revenue should be 8,370. But we recorded $3,720 of revenue in 2015. So we can't record $8,000 and $370 in 2016. We'd be double counting. Simply take the 8,370 and subtract the 3,720. The difference is 4,650, and that's the revenue you would recognize. The actual costs are right in the problem at 1,500. Our gross profit is the difference between the 4,650 less the 1,500, which gives us 3,150, and that would be debited to the CIP account. Finally, in the final year, we have $10,000 of actual costs, bringing our cumulative construction costs to $14,500. Now the contract is 100% complete, so 100% of 18,600 is 18,600. But we've had already billed an additional 8,370, so there's going to be a difference. So out of that 18,600, we've already billed 8,370, so the difference of revenue is 10,230. The gross profit is going to be 10,230 minus the 10,000 current year costs. So the revenue is a little tricky because it's based on a cumulative effect, whereas the costs are straightforward. It's given to you in the problem. So here's a summary. Actual cumulative costs incurred 3,000. Estimated total cost 15%. Gives you your 20% cumulative percent complete. Actual cumulative cost in year 2 was 4,500. Estimated total cost would be 10,000, so that's 45% complete and 100%. Revenue and gross profit recognition 20% of the contract price is $3,720. 45% is $8,370. But notice you billed $3,720 the year before, so you recognize $4,650. Less the actual costs gives you $3,150, and so on. Output measures include measures such as miles of highway completed or square footage. So this is a part B to this. If you're not using cost as your percent of completion, you might use things like square footage or miles if you're building highways, but the principle is going to be the same. So your journal entries, as you accumulate these costs, are going to be debit to construction in progress, and you're going to credit materials, inventory, and supplies. Your billing is going to be accounts receivable, billings in construction as a credit. When you get collection, you're going to debit cash, credit the accounts receivable for the revenue that you billed prior. And the method output measure is basically the same thing I just went over, except using different percentage of completion. The journal entries to record the revenue, cost, and gross profit is you're going to debit the costs and construction costs as an expense. You're going to credit revenue on long-term contract from the revenue that you recognize. Your gross profit, which is the difference between the two, is going to go into this construction in progress. Your $7,000 debit the following year, you're going to recognize revenue of $4,185. So the costs are exceeding our revenue, so we're going to have to credit the CIP. The final year, you've got revenue going to $2,790,000. You recognize construction costs, actual costs of $500,000. Your construction in progress is your gross profit, which is accumulating the costs. Your billing on construction is then debited. Your construction in progress is credited, and so on. You have your basically T accounts. So let's review the construction in progress T account. $1,500,000 is debited for the costs. The gross profit also goes into construction in progress each year, so you have a balance. And then the following year, you have $7 million in construction costs. You do have a gross profit loss, so that goes as a credit. And then in year 3, you have your construction costs, your gross profit with a balance, and you close that out at the end of the year. Billing in progress is your contra account. So as you bill out, you have your contra account. Your billing should eventually equal your cost plus your gross profit, okay, in your CIP account. So these two numbers, the $9,300,000 balance as a credit should equal your $9,300,000 balance as a debit in your CIP account. You close that out. Accounts receivable eventually gets recorded as debits and credits as you collect cash. As you collect all of it, it should zero out. But when you do your balance sheet, your income statement and balance sheet, on the income statement, you're going to have your revenue from long-term contracts and your cost, which equals your gross profit. These two numbers, cost of construction and gross profit, should be in your CIP account right here. Construction in progress is going to be your revenue. So your revenue minus your cost will be your gross profit. To present it on the balance sheet, you're going to have your construction in progress and you're going to have your contract count, which is the billing on construction in progress. This CIP, which is the asset, is less than your billing on construction. Essentially, you have a liability, a net asset which is negative, which is a liability. Same with 016. On the asset side, you've got 900,000 less the liabilities of 1,675,000. So this negative net liability is now presented as a liability. Had this construction in progress been greater than billing, you'd have an asset. And this would be presented on the balance sheet under assets right here, costs and recognized profits in excess of billings. But because it's negative, you have to show it as a liability. So that essentially is a review through our PowerPoint presentation, which is on Canvas. It's a very good presentation. It explains everything very well. I just wanted to basically summarize that for you real quickly, and we'll be going over problem 8 in the homework shortly. Thank you.